We're live. Let's make sure we don't look like we're in the Stone Age, though. Just want the quality to be good so people actually look at it. Oh, it looks great. We're live. Let's make sure we don't.
Are you putting your phone on Instagram?
Yeah, I'm gonna set up on Instagram and then we're good to go.
Perfect.
Make sure we're on. I guess I could go from like right here though too. Okay. We're live. All right.
Awesome, buddy. How's it going?
Good. How are you?
Good, good.
All right. Thanks for coming on, man.
Absolutely, anytime.
So
Long overdue.
yeah, we're gonna get into a lot of good stuff actually.
Yeah, I think so.
So
Forward to it.
first of all, for people who don't know, I'm Ross Doroshenko. I'm a realtor here in Edmonton. Cory is my main mortgage guy. We've helped. I think we're at hundreds now.
Probably getting there, yeah.
Yeah.
It's a lot.
Yeah,
I got a list and it's long.
Yeah. So Cory does the financing. I help people find the houses. And today we're going to get into some interesting topics. So we've got 4 topics that we're going to cover mainly. So first thing we're going to get into is like interest rates, where they're at now, the history of them, where we both think that they're going to be headed. Second of all, we're going to get into is how how interest rates affect the real estate market. What happens with prices? How does that change the housing market? Thirdly, how and why does the lending rate change? And the biggest one, difference between variable and fixed, because not a lot of people realize that they're based on different factors.
Yeah, it's a big misconception for sure.
Yeah, and then finally we're going to get into what kind of market we're in right now and where we see the Edmonton housing market kind of heading. So, yeah, let's jump into
Let's do it.
interest rates,
Cool.
COVID, all that kind of stuff.
Yeah, absolutely. Obviously,
Yeah.
things have been pretty wild over the last little bit. We kind of boomeranged all over the place.
Yeah.
Going into COVID, we were pretty standard, pretty balanced. And then obviously COVID happened and rates just got chopped down really fast. The Bank of Canada acted really quickly. They chopped their prime rate down to almost nothing. And it sat there for like 2 years.
Yeah.
Now, obviously, we're increasing fast. Part of the reason for us increasing so fast is because we sat so low for so long.
Yeah.
That was part of the issue. A lot of people kind of urged the Bank of Canada to increase. Like we had kind of hit points, when we got like 3/4 of the way through COVID and stuff was like kind of back to normal, but
Yeah.
rates kind of stayed low. So a lot of people were urging the Bank of Canada to start, implementing those increases. They came out and said, well, we're gonna, keep rates low for a long time, maybe till 2023. Inflation was kind of on their radar at that point. It kind of knew it was coming. Supply was a huge issue.
Yeah.
We saw like the market was crazy, right? So it was kind of, we could see it coming in the distance. So a lot of people were telling them to increase rates. They waited too long. Then they kind of got into a spot where it's like, crap, now they're kind of behind.
Yeah.
So they've been playing catch up for the last little bit. Rates have gone from 1.5%, 2%. Now they're sitting around 4.5 to 5.5, depending on fixed, variable, length of term, that sort of thing.
Yeah.
Before the pandemic, they're kind of in the 3.5 range. So where we just kind of passed for a long time, we were still below pre-pandemic. We just sort of just passed that. We're pretty average now. Like rates for a long time have been in the 4s to 6s has been very average. I mean, we've gone through periods of 20s, right?
Yeah.
And teens has been normal. We hit 20s in the 80s and then teens in the 90s.
Yeah.
I don't think we'll hit double digits. Obviously, nothing to know for sure. There is going to be a few more rate increases coming. It's looking like one at the end of October.
Yeah.
Bank of Canada will do another looking like rate adjustment, and then one most likely in December. But it's very case by case scenario between each one. So that's kind of the trajectory we went through. Bottomed out through COVID, stayed too low for too long.
Yeah.
Now they're trying to play catch up, basically.
Yeah, and I mean, I think people got a little bit mad just because they said that, you know, we weren't going to have those increases come till 2023, but I don't think anyone could have predicted the way that our economy was during COVID.
Yeah, 100%. And that was a big issue, though. A lot of people made decisions based off of what they said.
Yeah.
So that was a pretty big one. And then they kind of came out after, and they're like, well, you know, they saw inflation coming. They're like, you know, it's transitory. It's not entrenched. We're not too worried about it. They're clearly kind of wrong. It's more entrenched than they think it is now at this point, sticking around for a lot longer. And because they waited so long, it kind of created more of an issue.
Yeah.
Whether the increases are solving the problem is kind of a whole other topic, because supply is the real issue, not necessarily the interest rates. And they're kind of creating this inflation spiral now where people are now going into work and asking for raises because their mortgage payments have gone up so much, or the costs have gone up so much, which is just creating
but we're not paying people more.
Yeah, exactly. So it's just kind of creating a bigger issue. You know, wages are going up to accommodate for it, but then they just keep increasing risk. So that's the problem. That was the big issue made. So it'll be interesting to see what happens, but the big issue was staying low for too long, them not saying they were going to increase, and then now increasing them faster than they ever have, which has caught a lot of people off guard, I think.
Yeah, and I think that, and that kind of gets into the conversation too, where we think that they're going to be headed. And it gets into they are following the housing market too, because they don't want to see the housing market completely tank.
Yeah.
But I mean, it's just very different because Canada's housing market, there's really no such thing as Canada's housing market.
Yeah, it's pretty wild, even province to province, right?
Well, that's the thing. It's so different, right? So people on the East and the West, and we'll get into that when we kind of talk about how they affect the real estate market. But do you think that there'll be, because it's something I actually wanted to ask you, and I've never asked you this, do you think that there'll be, what is going to be a telltale sign for the Bank of Canada to be like, okay, we're done? Is that going to be when supply comes back up?
Yeah, there's no
what's
right
based on
answer
that?
for it, right? Like it's always going to be, they meet 8 times a year, and even pre-COVID, they're still making adjustments. People just didn't pay attention to them as much because it wasn't front and center.
Yeah,
and also the adjustments weren't nearly as big, right? Like a quarter-point adjustment was pretty normal.
Yeah,
and you wouldn't see the impact. Lately, they've done a full percentage, and then they did 0.75. So they've done more increases and heavier increases than they have, which has caught a lot of more people's attention.
Yeah.
We can get into a later. Fixed and variable are actually going off different things. People see interest rates going up, and they think fixed and variable are going up. They have both gone up, but they're based off of different metrics. So when the Bank of Canada comes out and they make a change to prime, it's only affecting variable. Fixed is totally separate, based off the bond market.
Yeah.
So when they come out and they make that change to prime, it's only affecting variable rates. But I mean, then it affects line of credits and student loans and stuff like that too. As far as when they'll make that change, it's honestly, anything that anyone has guessed over the last little bit, most people have been wrong, right? So
and it follows inflation, right? And that's the thing where so many, it's it all follows the price of goods and services. Yeah, it really does, right?
100%.
Mostly.
Yeah, for the most part, they're going to be projecting for what kind of changes and impacts that each rate increase is going to have.
Yeah.
The hardest part is, though, and why a lot of people are worrying, and same people who told them to start increasing earlier are also telling them to also be careful about how fast you increase, right?
Yeah.
Because the problem that they're having now is they made a lot of changes really, really fast. And a lot of these changes, you won't see the impact of it for 6 months, maybe 12 months or longer.
Yeah.
Because anyone who's on a fixed mortgage their payments haven't changed at all.
Yeah.
Right? So anyone who's coming up for renewal, they're the ones who are going to be impacted.
Yeah.
So that's part of the problem too, is where they're making these changes, they're waiting 6 weeks, seeing what happens, and then making other changes. But realistically, it could take 6 months for those changes to actually take effect.
Yeah.
Because it did anyone on a variable rate mortgage, not even a variable rate, an adjustable rate. Because some people are on a variable where their payments aren't even changing, right?
Yeah.
They're just paying more principal.
Yeah.
So the only people who are really being impacted are anyone on a variable rate or adjustable rate mortgage, where their payments are changing. They're the only ones who've been impacted. Anyone else on a fixed rate hasn't been impacted at all. They won't see that until their mortgage comes up for renewal, right?
Yeah, and you can be on a variable and not have payments change.
Exactly.
Then your increase, your
you'll have a really
right?
hard reset at there's been some crazy people with you start off with amortization at 25 years. And they're on a variable rate mortgage where their payment doesn't change. So they're just paying more interest. And
but you don't notice it much.
There's don't notice it, but
Yeah.
some people have logged into the online banking and their
like, what the hell?
amortization's gone to like 70 years.
Yeah.
It's wild. So people log in and they're like, holy crap. Like they're kind of shocked, right? But they'll see a hard reset. They can start supplementing that with increased payments now.
Yeah.
Or if they want to keep their cash flow, high, they can leave it, but they'll have a really hard trigger, at, when it comes time to renew, because that's going to get reset and readjusted.
Yeah.
So they're going to see a big jump there. So a lot of the changes that they're making, the impacts aren't really being felt yet. So that's going to be something that's going to be interesting to see. But a lot of people are kind of urging them to, it's good that they're increasing, but they need to be careful with how fast that they do that too. So
yeah, and I think it's the same conversation that I've made. Like, I don't even know how many videos on about, through the pandemic, they were giving away free money.
Yeah, close.
They really
close
were.
To it.
Like,
We'll never see money that cheap again. Probably,
exactly.
At least unless something crazy happens.
And it was an anomaly because of what was going on. Like, we didn't know, and the governments, the governments worldwide never saw it before, so they didn't know what to do economically anyway.
It was basically like a safety button, right? They just didn't want things to completely just get crushed.
Yeah.
And they did an okay job. Like, I mean, they didn't do it perfect, but no one really knew what to do. Obviously, everyone will have their own opinions. We stayed closed for a long time, which really affected. Like, the real issue is supply with everything, right? Like, it's pretty simple supply and demand in this scenario, and obviously with supply being in such a being affected so much and demand getting so high, that is the biggest issue more than anything. Was there just, we closed factories, we closed everything, so supply was an issue. No, it's not as big of a problem in Alberta, but housing, especially in like Toronto and a lot of those places, supply is a huge issue. It takes like 7 to 10 years to go from a piece of land to a finished product, and there's so much red tape and regulations around it that they can't build nearly as fast. So supply is a huge issue in a lot of those places. Even before COVID happened, supply has been a huge problem in those areas, right? So.
Yeah, and I think the biggest thing too is, like, a lot of people get confused, especially in Edmonton. Okay, so for example, Calgary's gone up significantly because they think, well, we'll just start building out. You can't. Yeah, like, Calgary's starting to build up now more with more condos, and it's similar with Edmonton. It's like things can only happen so quickly, and especially because of the winters we have, it's not like we can just start putting up a house in 2 months type of thing, right?
Yeah, and there's also lots of activists and things that have, like, whether it's right or wrong, there's a lot of. It's very hard to get a piece of land and build on it. The government policy makes it very difficult, and it's a very long process. It's not as an issue in Alberta, but those other provinces where we see like everything's $1 million plus, it's a really big issue. So supply in those areas is a huge problem. And it can take like 7-10 years to get a condo built. So they just can't keep up, especially with how many people are coming into Canada. And there's a lot of jobs in those areas. So that's why we're seeing now more people come to Alberta to supplement it a little bit. Obviously we're lucky where our housing is still fairly affordable, at least to the rest of the country, but we'll see how long that happens. I think a big issue that we're seeing is people sitting on the sidelines because their friend or a family member got, the discounted rate like a year ago, and
it's not coming back.
Yeah, that's the hardest part. If you're gonna be waiting for that, you're gonna be waiting a long time. I can see them coming down a little bit, possibly. Like if they do keep jacking these rates, they're kind of putting themselves into a recession in a sense, right? And then we may see a small decrease or flatlining a bit, but it's not going to go back to like 1.5% or 2%, right? So if you're waiting for that, you're going to be waiting a while.
Yeah, and the thing is too is, like, I always like to, speaking about that a little bit too, and then honestly we can get into the second point too of how it affects the market, right?
Yeah, absolutely.
But it's like there's opportunities in any market to be made, but you have to enter the market at some point. Right, because the thing is if you're in a seller's market, there's major opportunity there if you own property. But unless you own it, there's no opportunity. And like if you are only buying at the top of a market, then it's not great.
Right, like
if you are only 100%. Selling at the bottom of it, then it's not great either. But it's like there's always opportunity to be made. But it's for the average person that are just buying and selling their primary residence and that's it. It's all relative no matter what, unless you are initially buying your very first property. If you already own, it's basically just cancels out.
Yeah,
right?
the biggest people at the biggest risk is anyone trying to flip, right? Like
Yeah, exactly.
anyone, but it is even people even in Alberta, you're pretty insulated to those risks because Alberta prices aren't up and down like they're in other provinces, right?
Yeah.
So even in Alberta, you're pretty insulated to a lot of that stuff.
Yeah.
But even if you're buying a rental, like I wouldn't, even with today's rates, we got a rental, like 6 months ago. It's like I'm not against it at all. Like
Yeah.
Edmonton still cash flows really well. You
Yep.
can get multiple units on one property.
Yep.
We've worked with people who've kind of had that analyst paralysis, right, where they've sat on the sidelines from pre-COVID rates
Yeah.
into COVID rates, and then
Yeah.
now and they still haven't done
3
anything.
years later, and they still
Yeah,
haven't
they're
bought
like
yet.
they're like when rates went as low as they were in COVID, they're like they're gonna go lower. I'm gonna wait, right? And there was news articles about there being negative interest rates and stuff like there was in like Sweden or whatever it was,
Yeah.
right? So then they were waiting for that, and now they've gone up, and they're like, well, I'm gonna wait for them to come back to what they were before, and you got to do something at some point.
You
right?
have to enter the market at some point. So yeah, I mean, let's chat about how they affect the real estate market.
100%.
And I think the biggest thing to get through to people is there's no such thing as Canada's real estate market. It's based from city to city. Because we're not Vancouver, we're not Toronto, we're not like, I mean, the east is probably the craziest. That's where we saw the most. Like Toronto, it was like a bubble, and it just started to spread, right?
Yeah. It's insane, and I'm sure you've even talked to other mortgage brokers. Like we do stuff in other provinces a little bit here and there, but when you talk to it's literally like its own beast, right? Like you talk to brokers out there, and even the way like stuff gets underwritten and like it's
different.
It's way different, and then also just they don't even write conditions, which is just crazy. Like there'll be $1 million purchase, and it's like we're taking, at least it was. It's not as much now. It's cooled off a little bit, but at the heat of stuff, it was like we show the house on this day. We are accepting offers on Friday. They look at 20, and they're taking the one that has no financing and no inspection condition, right?
Obviously.
Like you can't even write conditions, which here is like crazy because I mean we did get a little bit of that for the first time, but which is like just it was nuts, right? So,
yeah. I think everyone's just scared if there's going to be a major economic correction. I think that's what everyone's scared of. And I mean, everyone is right now, right?
Yeah.
Like, that's the biggest thing. But at the end of the day, it's like inflation, the way you look at it, the real estate graph. Like, okay, so the crash in 2008, when that happened. So first of all, interest rates affect prices. They go down. Yeah, when prices go down and interest rates go up, but rent increases significantly.
That's the challenge, right? Is a lot of people, even right now, a lot of people are like, do I sell in a rent? And it's like, well, rent's going to go up. Like we're having the same issue on some of our places, right? Is if you're especially if you're on a variable, but even if you're not, like a lot of landlords are going to increase rents because they can, and whether it's right or wrong, but rents are going to go up as interest rates go up because their payments and their costs, and especially like even this past winter, heating costs were insane.
Oh, it was crazy,
right? Like it was like $500-600 a month.
Yeah.
So rent's going to go up to supplement that. So even if you're planning on, which isn't like I have no issues with renting. Like I think renting has its place for sure for certain scenarios. I think renting gets a too bad of a rap when there's a lot of scenarios it does fit for a lot of people for a lot of scenarios. And some people I think should rent longer before they purchase, and they put themselves in a worse situation when they could have just waited and rented. And but if you're of the mindset that I'm just gonna rent to save money, you're probably not good. Like your rent's gonna go up too. So
yeah, no, and that's the biggest thing where it's like you're not. I don't like, again, everyone's situation is different. Do I think now is a bad time to buy property in Edmonton? No. I'll just say I don't. I'd give people my honest opinion. I don't think it is. I think we're a balanced market.
100%. Like I'm looking, like I have cash inside, and I'm still looking for I love the multi-unit property, basement suite, garage suites, and I'm always looking. Like Alberta's so cheap to everywhere. Like so even if you see like a little bit of a price drop in Alberta, it's like okay, you went from like, you buy like a townhome or whatever, your rental, and it's like $350 and it drops to like $320. Like over the long term, you're going to be fine. And as long as you're not looking to flip it, I'd be a little bit more worried if I'm purchasing at $1 million or 1.2, and then you're losing $300,000-400,000 worth of equity. But those places have seen a crazy increase in prices, so seeing a big decrease is normal. But we haven't seen that increase here. Like we've been
we don't fluctuate.
So long. No, so like we just cash flow really well. So.
Yeah, and the thing is too, is I tell everyone this is like, the thing about Edmonton and Alberta specifically, there's been almost 50,000 people that have moved here in one quarter. We chatted about this.
Yeah.
So that's 50,000 people in one quarter just to Alberta, primarily Edmonton and Calgary. And that's not slowing down. So that's keeping our market extremely active. And these people are not from out of Canada. They're from within Canada.
Yeah, 100%. Like
Right?
I've done more. Like I worked at Daytona for 5 years and more. So doing it for 8 years now.
Yeah.
And more out of like you said, out of province people coming into Edmonton more this year than in all the other years combined, right?
Yeah.
And a lot of them too, like any first time home buyers, like getting a property as a first time home buyer in those places is incredibly difficult because a lot of people who've owned homes over the last 5 years there, well, they have a lot of equity where they can sell or pull it out and buy something else. So they have the advantage that they have the equity and the cash to do it because they've been a part of that appreciation.
Yeah.
But anyone trying to come into the market doesn't have that. So it's so hard to get into the market as a first-time home buyer unless, you're lucky enough to have a gift from a family member or something like that. But a lot of people don't have that luxury. So they're looking for more affordable cities. And then the other issue you run into is a lot of those cities, everything's starting to get over $1 million and it's no longer insurable through CMHC. So, you now need 20% minimum. So it's like, it's just so unrealistic for a lot of people that, we've had, me and you have done a lot that have come back to, not come back to Alberta, just strictly moved to Alberta for affordable housing.
Yeah. So. And I think everyone's just frustrated in Canada because of the cost of living.
Yeah.
And that isn't just the real estate market. That's all of it.
Yeah. 100%.
That's everything. Right. So, I mean, in short, what we're seeing now specifically in Edmonton, our prices have decreased very slightly.
Yeah. Like you never know, like your tax assessment is probably going to be pretty much the same. You know what
exactly,
I mean?
Right?
It's nothing that you're going to...
Yeah, and we don't fluctuate that much. Like I tell everyone this. At the very bottom of our market, which was like beginning of 2019, I think.
Yeah.
So our average price was, I think it was about 340,000, 350,000, something like that. At the very top of our COVID market, we saw about 440. So there was $100,000 swing there, but now we're back down to about that 400 mark. So it's gone down a little bit, but you got to remember, we're just talking about $100,000 average swing on the average house. So things have gone up, especially in certain areas. St. Albert, Sherwood Park, Spruce Grove even has increased a ton, but we're already seeing that correction. So if people are thinking that prices are significantly different than they were, they're not.
No, it's really not. It's not like, and it's proportional too, right? Like,
always.
And Alberta has been good, and like that's the thing. It depends on what your plans are with the property, but if it's going to be a primary residence is like one of the best tax shelters in Canada, right? Yeah. You pay no capital gains on it. It's like a savings. Like owning a primary residence in Canada is like one of the best tax deferred strategies you can get.
100%.
You pay no capital gains tax on it. So, like owning a primary residence in Canada, I think is amazing. And if you're sitting on the side, like I said, like renting's not the worst option ever.
Yeah.
But don't sit on the sidelines. Like I think I think I'm just saying that more because I've had so many people reach out to me being like, I don't know what to do. I don't know if I'm going to purchase anymore. And that's totally fine.
And it's frustrating for everyone, especially in our industry, right? Yeah. Because like we can just be honest, where it's like you have someone that's so on the fence, we'll spend so much time with them, and then they're like, and I get it.
Yeah, like it's scary too, right?
Yeah,
like
it is.
So 100%. I understand that too. And there is a point, like the one thing I do with a lot of my clients is a lot of people get so caught up in purchase price and they don't even look at the payment. Like the amount of time I've had someone just be like, what am I qualified for? And like they want to go out and buy that. They don't even look at what the payment is or have any idea what the payment is. So like we make a point to go through the budget with a lot of people. And maybe because of interest rates have gone up, maybe you supplement it a little bit and buy something slightly cheaper to make the difference.
Yeah.
But I think where a lot of people now, if you're waiting because they've gone up, then you're gonna be like, they have an unrealistic expectation of what rates are because they've seen 1.5%. A lot of people have entered the market
and they get so focused on that.
Yeah, that's all they focus on, right?
Yeah.
So it's funny. I was talking to my grandpa the other day, and he's been in real estate for like 60 years. And he's like, "What are rates at now?" It's kind of like, they're in 4.5, 5.5. And he's like, "Man, when I was buying a house, like that was a pipe dream for us. Like they were like 22%.
Yeah.
Obviously, house prices were way cheaper, so it's relative.
Different time, yeah.
Yeah, for sure. But he is like I find the people who are the most concerned about rates entering the market are first-time home buyers who saw what rates were at and now feel like they're getting a bad deal or shouldn't buy now because of where they are.
Yeah, the clickbait mainstream media.
Yeah.
Just all is about the real estate.
Yeah.
And again, it's like they will always focus on what a good real estate market is. So the news and the media will always consider a good real estate market of people selling high, but then there's always that, that other side of things going, well, housing prices are, so high, blah, 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 blah. But then you'll see also in the news where it's like housing pricing down, and it's like, it's always a negative spin on things. And that's where I tell everyone, I'm just like, there's opportunity in the market no matter when it is, right? And it's a long-term game.
Yeah, 100%. And it's funny that you say that because, if you had a rental property and you sold at the height of COVID, you might have done well. But for the majority of people, we're talking primary residence.
Yeah.
And anyone, like I worked with a lot of people, they sold their primary residence during COVID, but then they had to buy something else.
Yeah,
so
relative.
You're buying at the increased price anyway, right?
Yeah.
So they got a great sale price, but then they had a higher purchase price.
And it was harder to do because stuff was going like this.
Yeah.
So like a lot of people couldn't even oh man, doing interim financing during that time was so hard because like people wanted 30 days on their house and it was extremely difficult to do.
And the stress,
now it's way easier.
I was going to say, like, if I was a buyer, like I'm almost more comfortable in today's market because
much more.
When we were like at the heat of COVID, like there were how many young buyers did we have that were like, they felt like they were so stressed and they're like, I have to make an offer.
They walked away, man.
So many of them walked away.
So many people walked away.
Because it was so stressful and like they wanted no conditions or you didn't like we did there was people doing no inspections. Like they didn't really have a choice. Where now, like, don't get me wrong, you're going to pay a higher interest rate, but how many people did we have who kind of settled on a house? They're like, you know what I mean? They just made a choice. They found one. They're like, I need a house. There's limited options, right?
Yep.
Like I just had a family friend who purchased a house, and they were looking all through COVID, and they purchased now, and they had way more selection. They had way more time to do their inspection.
Yeah.
They were way less stressed. They made like 2 other offers and ended up losing out on them. They waited, and now they made a purchase now. Yeah, they paid a slightly higher interest rate, but they got the house that they wanted, and they got all the features that they wanted.
Yeah.
And the process for them was way less stressful, way smoother. So it's relative, right?
Yeah, absolutely. And I think actually we didn't even mention that, but it's like I had a ton of clients that just gave up, and I don't blame them.
A lot. Like we had we did.
And I don't blame them. But the thing is now you're not going to see that. But if it's a good property, it's going to get multiples, and you're going to be
it's still competitive,
for sure.
Right? Yeah.
But it's like it's nowhere near what it was, like not even close. We're a balanced market now, right? Like there's lots of houses, and I'm telling everybody this, which is really interesting about Edmonton, is like I'll list a house that I think is going to sell like within a month, and it sits. And then I'll list another house that I think is going to like maybe sell in a couple months, and I get an offer on it right away. Like it's a strange time, right? So, I mean, every real estate market is affected differently. But typically it's like, we're going to see prices probably balance out a little. I don't think they're going to come down much more than they already are now. Maybe they will. But the thing is like the cost of living that's not changing. Until that changes, we're not going to see a correction. Yeah. Let's get into the difference between first explain variable and fixed, and then let's go into how those change.
Yeah, so fixed is pretty simple. You can take any length of term from 6 months to 5 years, 10 years. Standard that you see most people as a 5-year term. Yeah. Fixed, you get an interest rate, and you're staying in that interest rate for 5 years. So you have a 25-year amortization, and within that 25 years, you break it down into smaller terms. So you have a 5-year term, you'll lock in an interest rate at, whatever, 3%, 4%, and you'll stay at that rate for 5 years. When it comes up for renewal, you will then shop your mortgage around again and get a new whatever term you want. So fixed is pretty straightforward. It's the simplest, right? The biggest disadvantage to fixed are the penalties. So we saw during COVID, rates came way down, right? Yeah. So people were in 4%, 3.8% kind of range, and then rates came way down to 1.5%, 2%. And anyone who was in a variable got to ride that down, or they could just break it for very cheap and sign up at new rates. The biggest disadvantage with fixed is it provides kind of a false sense of security where it's great and it's fixed, but if you need to break that mortgage, you can get crushed on the penalty, right? Like Alberta, we have lower mortgage amounts, but $20,000 penalty wasn't unheard of. Yeah. In certain other provinces, like where you got that million plus, there was like $50,000-$60,000 penalties. Like it was crazy, right? Yeah. And everyone says I'm gonna be at this house for 5 years, but the statistics show like 6 out of 10 break their mortgage. And there was actually
within 5 years.
Yeah.
Really?
Yeah.
6 out of 10.
Yeah, 6 out of 10, right? Because 5 years is a long time. And think of how many first-time home buyers, right? Purchase and like, because even you were thinking of purchasing, right? Like a lot of people, like especially first-time home buyers, they'll get a townhome, condo, whatever, and then they're up. Like 5 years is a long time, right? Like from the start of your career to 5 years in, you're usually earning a lot more. You're having a family, whatever.
Yeah, life changes.
You move for work, right?
Yeah.
Like so. Anyway, so that's where the biggest disadvantage with the fixed are the penalties, is where we see. So you get the luxury of just setting it and forgetting it, but if you do have to make changes, you can get suckered into big penalties. And it's not always the case. Like I have people who are on fixed and their penalties were reasonable.
Yeah.
But I've also had people that are just like astronomical. Like in certain scenarios, it's actually stopped them from being able to sell their house because they've been so crazy. And there's actually a CIBC, an ex-CIBC guy talking the other day, and he said 1/3 of their profits for their division was from the not even the interest rate, it was the penalties. The fixed penalties made up 1/3 of their profits.
Really?
Yeah, which is just wild to think about. So the way they calculate it, it's called
Watch what you're signing.
yeah, right. It's called an interest rate differential is the penalty, and you either end up paying an interest rate differential or 3 months of interest. And the interest rate differential, they will tell you, like if you call in to the bank and be like, hey, what's my penalty? They'll be like, here's your penalty for today and today only.
Yeah.
And tomorrow it could be different.
Yeah.
And I've seen them jump like $5,000 within a certain time period. I'm not going to go into how it's calculated because it's not really that fun, but it can jump. It changes all the time.
Yeah.
Variable, on the other hand, is broken into two. Everyone thinks variable is the same, and it's not.
Yeah.
Everyone just calls it a variable, but there's actually a variable and an adjustable.
Yeah.
Variable, your payments are going to stay the same. So basically, you sign up at a rate. Your rate can change and fluctuate, but your payment's going to stay the same. What's going to change is how much you're paying towards principal and interest.
Yeah.
In a adjustable rate mortgage, your payment will constantly change as the rate changes to keep your same amortization. So if you set up a 25-year mortgage and Bank of Canada makes a rate announcement, your payment's going to change to make sure you pay your mortgage off in that same 25-year period. Yeah. That's what I was talking about earlier, where there was people signing in who were on a variable rate mortgage who signed it and saw like 70-year amortizations because they're basically paying mostly interest. There is a trigger point in there where the bank will call you and you can adjust it and things like that, which we're starting to see now. But those are kind of the difference between the two. And the difference between that is when the Bank of Canada comes out and they make an announcement, everyone's like, okay, interest rates have increased, right? They just think it's across the board, but it's only variable rates.
Yeah.
Fixed rates, not based off of the Bank of Canada. Bank of Canada does not set fixed rates. They're based off of the Government of Canada bond market.
Yeah.
So that's how they're going to set fixed. So they do move at similar times, but not always. Like there's periods of times where fixed will drop below and variable, like they'll swing around, right?
Yeah.
So there's always news headlines when the Bank of Canada makes a rate announcement that interest rates have changed and everyone thinks fixed has changed. And that's not always the case.
So variable and adjustable are based on
the Bank of Canada.
The prime.
Mm-hmm.
And the fixed is based on where the bond market's at.
100%. Yeah,
Interesting.
Exactly. So that's the biggest thing. Like I have people who they hear the Bank of Canada rate announcement coming out and they think they need to lock in before the announcement because the rates are going to change. And it's like, I mean, sometimes it lines up for that, but the fixed rate can change at any time. Like for instance, like lenders will send us out fixed rates changing whenever.
Yeah.
Variable rates are Bank of Canada announcements. Right.
Interesting.
Yeah, so a lot of people will be like, well, I had a client call me the other day, and they're like, I have to lock in or make a decision to lock in before the rate announcement. But, fixed could be the same before and after the rate announcement. Their variable could change, but their lock-in rate could be the same. But it could also change if the bond market fluctuates, right?
Yeah, and that's where having a mortgage broker is extremely, because I made a video about that the other day. You shared that one. I was like,
it was good. Yeah.
Well, it's very true where it's like so many people get caught up in interest rate. What's the rate at? What's the rate at? And it's like they'll just walk into their bank and they'll take whatever product they think just because it's a major bank. And it's like, man, that is so the wrong way to go about things.
Yeah, 100%. And it's hard. Like, there's always the rate question, and don't get me wrong, rate is a very important thing.
Of course.
It's kind of it's the easiest one for somebody to pinpoint where their cost savings are going to be, right? Yeah. But there are so many other ways to save money on a mortgage. One of them being penalty. Like, like there's a lot of people who, like banks will pretty much always sell you a fixed rate. That's always is a 5-year fix.
Because it makes them the most money.
Yeah, it makes them a huge amount of money. Yeah. So, historically, variable has always saved more money. We're in a pocket of time right now where obviously if you took a fixed rate at 2%, you were looking pretty good, right?
Yeah.
The only thing is you still don't know until the end of your term, because I've had people who signed at 2% and they've already broken their mortgage and they paid like I had somebody who built a custom home. They're like, it's the one, we're staying here forever.
Yeah,
they
you
took the
told
fix.
me, yeah.
Yeah, they took the fix, and then they didn't like how the things worked out with the builder, and they weren't happy with their neighbors, and they called me like 3 months after to break it, right?
Yeah.
So you don't really know, and even people right now, there's people right now who are in a variable and or an adjustable, so maybe their payments have gone up, and you know they're feeling the heat of that, which makes sense. You can lock in, but they also don't know what their cost savings are going to be until the end of the term, because we could come back down, or they could break it, and that penalty could offset the difference, right? So there's thousands of different scenarios. What I see most often is people just get a 5-year fixed, right?
Yeah.
If I were, what I'm recommending for a lot of people too is take a 2 or 3 year fixed too, right?
Yeah.
We're at the highest fixed rates we've seen in a while. Why not take a 2 or 3 years? These things typically run in 2-year cycles, right? So take a 2-year. It's going to be a lower rate than the 5-year. Plus, you probably be able to sign up at a lower rate than we are now. Not for sure, but at least if you're in a time period where you don't know, you can take that 2 or 3 year fixed where. At the amount of time where people, I'm like, okay, well, you know, maybe they've talked to somebody else or talked to a bank or whatever, and I'm like, okay, well, what's the strategy behind the 5-year? Like, why are you taking the 5-year? And they're like, I don't know, like they sold me, like that's what I picked or whatever.
But
they
I just
no
trust
idea.
because I walk into my
Yeah,
bank,
they have no
right?
idea why, and that's the first question anyone asks too is like they want to know the 5-year fixed, and for a lot of people it works out, but there's tons of different options out there. There's lots of different scenarios depending on what you're looking at doing, how long you're going to be at the house for, are you going to convert it to a rental down the road? So there's lots of different scenarios, and there's nothing wrong with the 5-year fix. Like, it's still a really good product for a certain scenario. It's just not the only one. Just make sure you're choosing one with a strategy.
Different markets too.
Strategy in mind, 100% different markets, right? So just because you're on a 5-year fix on the last term, even if it's the same house and you're coming up for renewal, doesn't necessarily mean you have to take another 5-year fix. What ends up happening 99% of the time is your bank sends you a renewal offer in the mail, and people just like sign it. They don't even like look at it. They just sign the renewal offer, not knowing that you can. And usually those renewal offers are high.
Yeah.
You can walk into the bank as a new borrower and get a lower rate than what they're sending out to their own clients. It's like no different than like Shaw and Telus, right? Like you can.
If you fight them, then you'll actually get
like
something.
you go to Shaw and they give you like a new TV and like everything else.
Yeah.
And meanwhile, Rod or whoever won't, right? So it's very similar. It's unfortunate, but just make sure that's the biggest thing is if your mortgage is coming up for renewal, like take the time to just like call a broker or do a little bit of shopping and digging around. You might get a better rate somewhere else.
Yeah.
Or you might just not be. You might not want to be in another 5-year fix. Like I've had the amount of people I've had. You will also certain lenders will auto renew you into a product. So there's been people who they're planning on selling their house and they have it listed for sale, and they get auto renewed into another fixed product and have a massive penalty like soon after. When they could have just renewed into a variable or an open or something like that. So there's a lot of strategies that you can take into consideration. And penalties are probably the biggest one you have to be aware of, right?
Yeah, and it doesn't make it easier. A lot of people think, oh, it's easy if I walk into my bank. It doesn't make it easier. Corey can do everything over the phone. And like, it's actually easier going with you.
Yeah, well, the amount
than
of
it
deals
is
that
going
we've
with the
had
bank.
where they've started off at the bank and they've
Had to save it.
There's a lot, right? So I mean, it's, and don't get me wrong, there's lots of good bank reps. There's lots of really good bank reps.
Oh,
too.
100%. There's
It's
lots
just-
of good bank
It's
reps,
just a lot of the ones in the branch specifically sometimes are more focused on like mutual funds or RSPs, and they don't always do mortgages, but they're never going to turn away a client. But just making sure whoever you're working with that they're just taking the steps to educate you properly, because I find so much in this industry, and it's the same in the real estate industry too. It's like a lot of people just want to get you in and out and get paid, and they don't talk about a lot of the important details.
100%.
So I think that's an important part. Just make sure that your questions are like, if you have questions and they're not being answered properly or you're unaware of, like, just make sure you're asking and getting the right answers, because there's more to it than just
Purchase price and interest
Yeah,
rate.
exactly.
Yeah. Let's see if we have any questions on Instagram. Probably not. Oh, we had a lot of people join though.
That's good.
Oh, we do have a question from Nathan. So Nathan asked, you both mentioned that it's still a good time to get into the market, but is there a time where it won't be a good time?
I mean, there could be for sure. Yeah, absolutely. Like, I mean, it totally just depends, right? Like, if we see, like, I don't think we'll see it, but all of a sudden, if we start seeing double-digit interest rates and home prices still climbing, like, for sure. But I mean, typically, when you see interest rates go up, house prices are going to come down.
Yeah.
So you can kind of balance it out. But yeah, there could be a time where it doesn't make sense. Like, if you can't comfortably afford it anymore, or for somebody who maybe the other thing we can get into is the stress test, right? So now with the stress test, as rates are going up, your affordability is going down, because the stress test is you have to qualify at 5.25% or 2% above the rate that you're getting.
Yeah.
So up until recently, people only ever had to qualify at 5.25%.
Yeah.
Now rates have climbed so much, they're qualifying at 2% above that.
Yeah.
So now their affordability is being affected as rates climb, where they weren't in the past. So sometimes where it might not make sense for somebody, or more they may want to rent for a little bit longer, is maybe they're ready, or they thought they were ready 6 months ago, but maybe they didn't have their down payment or anything saved.
Yeah.
They're now looking, but rates have gone up, and the house that they need, they can't afford anymore, right? Yep. So that might be a scenario where, okay, you have to save up a little bit more down payment, or you increase your income, or pay off debt, whatever you need to do.
Yeah.
So like I just had a conversation with somebody yesterday, and that was the exact scenario. They could buy right now, and we both agreed. I was like, you know what, you guys, like, they're gonna go live with her daughter actually for a little bit. They're gonna live rent free. They're gonna get some debt paid down.
Yeah.
He's starting a new job. It's gonna be higher income, and they're gonna be able to qualify for more, and they're gonna have less debt, and it's just gonna be much more comfortable.
Every situation is different, and that's where it's really important. And I mean, that kind of comes into like our closing remarks too, is like what kind of market we're in now.
Yeah.
It depends on where you're at in your life.
That's the biggest thing. It's so situational, right? So there's a lot of people who, like, I think there are times where sometimes people do jump in too fast, and they kind of get that shock afterwards.
Yeah.
So I think for a lot of people, don't be afraid to rent that extra, or live with your parents, even rent, whatever, for a short period of time. If rates have gone up and your affordability is decreased, and you can't get the house you originally wanted, you don't have to settle. It's not the end of the world. You can take that extra 6 months, a year even, get that higher income job, pay off debt, put yourself in a better spot. There's also a new first-time homebuyer program coming into effect 2023. And they're basically combining an RRSP and a TSFA into one. So it's like the RSP homebuyers plan, but it's kind of better. So what you can do is...
no tax?
Exactly. So you can put it in like an RRSP, and you'll get an immediate tax deduction.
Yeah.
And ideally, you'll take that tax deduction and that tax credit and put it back into the plan as well.
Yeah.
And then when you pull the money out, it's tax-free. So
even if it's not for a house?
It's only for first-time home buyers.
Only for a house.
Yeah, so it's only for first-time home buyers. So that comes into effect 2023. So there's lots of new programs coming out that might make sense for people to wait, if you need that extra little bit of help and that extra little bit of boost.
Yeah.
My biggest recommendation for young people getting into the market is find out what your credit score is. Like, you can look it up online for free, or you can pay for it. It's cheap even if you pay for it. Try to get some active credit going. Ideally,
talk to you, man.
Two trade lines. 2 years, $2,000, kind of what they look for. 222.
Yeah.
And stay away from credit cards and car loans. Car loans are the biggest killer when I see qualification. For some reason, people love to purchase a house and a car at the same time.
Yeah.
And sometimes they purchase the car first, and it can just crush your qualifying power. So if you're looking at getting into the market, wait to buy a car, and try to manage credit cards, because the interest rates, they're really hard to manage once that gets under control. It kind of unravels on people. So,
and before, I think the biggest thing too, like the biggest piece of advice that I give to people, if you're thinking of buying in a year, call Cory now, because it's like, if you have a goal of a certain house that you want, and you can afford the month-to-month payments, and it's comfortable, but you might not, like, you might have to clear up some debt. You might like, there can even be some situations that you can set up your financial profile to make it way more affordable and to
way
have
more comfortable and less stressful, right? Like,
so it's like, plan that stuff well ahead of time. Because when you do enter the market, you want to be so fully aware, and you don't want to get pre-approved 2 weeks and then go shopping for a house. I find that people are much more comfortable if they start, 6 months in advance. You're getting to that point, what's happening, and it helps you save money too, because when you do that, the videos that you do and you send them to people with the different scenarios and stuff, they know exactly what to expect when they're walking into the situation.
Yeah, 100%. Like the difference between, we've got like for example, someone who was at the branch and we're trying to pick up the deal last minute. It's so stressful for the client. Sorry, my throat's dry. Compared to someone we've worked with for 6 months.
Yeah.
It's a totally different experience, right?
Yeah.
And you can weed out, some people might think they have no issues, and they go to write an offer, and they write an offer, and they found out they had a collections from TELUS who sent it to their past address.
Yeah.
And they didn't even know it was on their credit bureau, right?
Yeah.
And it delays the whole process. So
Yeah, which really messes you up.
yeah, there's little things like that. I've had so many people be like, no, my credit's great, no issues. And you pull the credit, and there was one where Buddy had one of those TELUS boxes, which he did return. TELUS just didn't categorize it or lost it, whatever. They filed the collections. It went to his old address. He had no idea. And like something as simple as that. And we got it fixed. Like we got it fixed with Equifax. We can help expedite that and do it for them.
Yeah.
But because he waited to write an offer to talk to us, he can't get that done in like 5 days, right?
No.
So you just need more time.
Yeah, you got to be prepared.
Yeah, 100%.
I think that's it, man.
Yeah, I think that's the most of it. I mean, reach out to the rest if you have questions. But I mean, I think the biggest thing is just chat with someone early, and don't be intimidated to talk with someone and think that like I talk to people all the time who are like, sorry that like I'm not buying right away. I'm like, it's just fine. Like I'm happy to answer questions.
I'm more than happy, because I'd rather have you call and feel comfortable to call me even though you're not buying than the opposite of that, right? It's like, no, it's like you got to have the professionals, like even Pierce, our buddy who's financial, he's an investor, right? So, I'll chat with him lots. And then when I'm actually ready to pull the trigger on something, it's like I'm very well educated because I've already talked to him 10 times.
And like the process is smoother. You're more comfortable. It's just way better.
Yeah. Well, that's all we got, guys. So thanks for coming on, brother.
Appreciate it, dude. Thanks for having me.
That was awesome.
Yeah, long overdue.
Okay, let us know if you have any questions. If you guys need mortgage assistance, contact Cory. But other than that, you guys can find us on Facebook, Instagram, all the social media platforms, and let us know if you have any questions. We'll see you next time.